Preparing your investment plan. The most successful investors were not made in a day. Learning the ins and outs of the financial world and your personality as an investor takes time and patience, not to mention trial and error. Therefore, your investing journey starts with a plan and a time frame when you know how long you're investing for and what you hope to gain. You can put the structure in place to achieve it. Learn also about how the market works. Figure out what investment strategy is best for you and determine what kind of investor you are. Be careful who you are taking advice from and be mindful of your own prejudices and assumptions as you find the right path for you. Make sure you understand this is a long term journey so that you won't be affected by short term setbacks and always stay open and learn from your mistakes. Let's review the important points of a personal plan for investing. One is to establish realistic goals. This has always to be tied up with your investment. Two, determine the amount of money needed to meet your goals. This is important for you to be able to make an investment. Three, specify the amount of money available to fund your investments. You have to determine the amount of money to be allocated to different types of investments in your portfolio. Four, list different investments you want to evaluate. Make sure you have choices of investments that are agreeable to you, but which you will therefore finally tune in terms of the actual investments you will make. Five, evaluate risk and potential return for each of your investments. This is to understand how the different choices of investments you've made within your portfolio can maximize your returns while maintaining or minimizing the risk. Six, reduce possible investments to a reasonable number. It will be hard to monitor as many as 10 or more of your investments, considering you have to do this on a daily basis. So choose those that are only important and that you can properly monitor. Seven, choose at least two different investments. The choice between investments will also have to depend on those that are not correlated to each other. So for example, if one is currently up, the other one might be down, and vice versa. Eight, continue to evaluate your investment program. Monitoring this on a regular basis will determine the strategies you will be employing and also those that you need to change investments over time. The most important financial planning document you will prepare, besides your list of personal and family goals, is your investment plan. In finance terms, your investment plan is also known as your investment policy statement. An investment plan is important because it creates a framework for every investment activity in which you will participate. It states what you will invest in, how you will invest, why you will invest, what percentage of your money you will invest, and so on. In short, your investment plan significantly affects your investment returns. And considering that your investment plan is a detailed description of all major components of your investment strategy, it will be best to write this plan well and then follow it up carefully. Therefore, the following four major components of an investment plan is what we will discuss next. Risk and return objectives. The first category of your investment plan is risk and return objectives. This category describes your expectations for returns on your investments. These investments will, to a large extent, determine your asset allocation decisions. In other words, these expectations will determine how you will distribute your investments along different asset classes. It will also address your expectations for risk and outlines how much risk you're willing to accept. So we start off with expected returns. You should not invest without any specific goals in mind. For your first goal, you should decide what return you expect your total portfolio to make over a specific time period. You cannot know with certainty what the actual returns will be before you invest. However, you can estimate an expected return or a goal that you hope to achieve during a certain period of time, such as a week, a month, or even a year. Note that you will determine also your expected returns for two periods of time. One is before your retirement, and the other is during your retirement. And there are several ways to estimate your expected returns. To give you an idea of how to estimate your expected returns over a period of time longer than 1 year, it may be helpful to look at your long-term history of asset classes that you have selected. Expected risk. Since a higher expected return requires you to accept more risk, it is important that you know your risk tolerance level or your willingness to accept risk. The place you are at in your life will likely have a big impact on how much risk you are willing to take. In general, when people are younger, they are more willing to accept risk because their investments will have more time to grow and overcome losses. As people grow older, they usually become less willing to accept risk because they will need their investment funds sooner for retirement or other purposes. The investors that have a low tolerance for risk, on the other hand, will typically devote their majority of their portfolio to bonds and cash because these investments are the least risky of all asset classes. However, they also provide the lowest returns. Investors that are willing to accept more risk, on the other hand, may allocate more of their portfolio to international and local stocks instead of investments in bonds and cash. The challenge of wise investing is to balance your risk and return expectations with your situation in life and your personal goals. Defining risk in your portfolio is also a challenge. Professional investors usually state an annual standard deviation as an acceptable risk level for your portfolio. For example, if it were at 12%, this means that the investor's average return being at 8% will have a 66% chance that the investor's return will be between 4% versus that of 20%. So in other words, given the average return on your investment, you do a plus or minus of the 12% standard deviation to get the entire range of what is the lowest from possibly what's the highest possible return your portfolio can be. However, instead of defining your risk tolerance level in terms of standard deviation, you can also define it in terms of the willingness to accept risk of the benchmarks you have chosen for your portfolio. You can determine how risky a particular asset is by looking at your investment benchmark. You can also determine a portfolio's risk level by comparing the portfolio to the weighted individual benchmarks. For example, if you choose a portfolio made up of 50% US stocks, 20% international stocks, 25% bonds, and 5% real estate, which totals to 100%, then your risk is equal to the risk defined by the benchmark of each of these asset classes. Investment guidelines and constraints. This is the second category of your investment plan. Investment guidelines are the roadmap of how you will invest over your lifetime. These guidelines and constraints explain the ways in which you will invest differently at different phases in your life. Young investors are typically concerned with accumulating and increasing wealth. As investors age, they become more concerned with preserving their investments and wealth. And as investors retire, they become more concerned with having investments that can be used as a source of income, so income-producing assets become more important to them. The determination of which of these goals is important to you will depend on where you are in your financial life cycle. Guidelines and financial life cycle. Generally, most individuals have 3 stages of their financial life cycle. Most investors who are younger than age 55 are in stage 1, or what we call capital accumulation and growth. Investors who are approaching retirement are typically in stage 2, where the main goal is investment preservation or maintaining the value of their investments. Investors who are retired are typically in stage 3, where their main concern is income generation or utilizing the assets that have been saved to provide income during retirement. Your investment guidelines should therefore provide you with a roadmap of investing your money at different stages of your financial life cycle. And these guidelines should integrate all of your financial goals to give you a complete financial perspective. Investment constraints. Once you have decided on your investment guidelines, you should identify your investment constraints. Investment constraints are constraining factors that you must take into account as you manage your portfolio. Your investment plan should address a number of important constraints such as liquidity, investment horizon, tax considerations, and special needs. Let's start with liquidity. Liquidity is the speed and ease with which an investment can be converted into cash. As you create your plan, consider how important it is for you to have the option of turning your assets into cash quickly. Ask yourself how much money you will need at different times in your life and how quickly that money needs to be available. In terms of time horizon, or otherwise known as investment horizon, that refers to the amount of time you're planning to keep an asset to save for a particular purchase. Consider how soon you will need to use the funds from a particular investment. Tax concerns. Tax concerns take into account your current tax bracket and your current tax rates. Consider your tax position. Are tax-free or tax-deferred investments more advantageous to have than taxable investments? You cannot simply compare the stated returns of particular assets. You must compare assets by taking into account that certain investments eliminate certain taxes and that other investments are tax-free. Unique needs and preferences. These are special needs constraints that relate specifically to your family, your business, and other areas of life that are important to you. For example, do you have a child with a disability? This may pose specific requirements on your investment plan because you will likely need life insurance to provide funds for a disabled child in case of your death. Is a large part of your wealth tied up with your company? This imposes constraints such as a decision of how you should invest in your company's employee stock ownership plans. What is important here, it is critical that you understand what your special needs are before you begin investing.